All right, so I really think you're gonna like this video. We're gonna talk about this infinite banking stuff. I mean, I have probably been talking about it for the last 3 years. I got involved in the insurance space probably about 3 years ago, 4 years ago. And, when I first got started, I was only like talking about the death part of the insurance. So I was sitting down, I was talking to people probably in their late 70s, trying to get some final expense. And over time, it became very difficult because people kept asking me about infinite banking, and I had no idea what infinite banking was. And I would look it up, and I would see little videos about infinite banking, and I had a really, really huge misconception about infinite banking until I ran into a mentor that really broke it down for me. So I want to really go into details, really take my time and explain this in a more simplified manner. I think that is one of my specialties. I'm able to break this thing down. So if I was you, definitely take your time with me. I'm just now getting started in this space on really breaking some things down. So if you could like, comment, subscribe. If you really like this video, if you got questions, just shoot it down. If you wanted to, book an appointment to really break something down for you and your family, hey, let me know. Click that button below so we can have a conversation, or somebody on my team can have a conversation. But I want to first start here. I'm gonna start with this video, and I really want to break down this video because I have a lot of respect for Dave Ramsey, a lot of respect for what he does. I pray, that he interviews me. A lot of respect for Anthony O'Neill. I pray that he interviews me one day, or they actually see some of my content. But I kind of disagree with them on this one concept that infinite banking is a scam. Reason why I do not believe that infinite banking is a scam is because insurance is not the only product that you can use infinite banking with. Infinite banking is nothing more than just a concept. And it's a concept that has to be broken down in its more simplest form in order for it to work. And it's a concept that you got to have a lot of discipline. And it's a lot of ins and outs that I'm gonna talk about through it. But let's roll the video.
Hi, Jason. Welcome to the Dave Ramsey Show.
Hey, Dave. Thanks for taking my call.
How are you?
Better than I deserve. How can I help?
Well, I had a question for you. I've been working with a financial advisor who's given me some advice, and I follow the show. I'm on baby step 7 currently. But he presented me with an idea that was a little outside the box. And I have term life insurance. I've been anti-whole life. But he presented me with this infinite banking concept.
Jesus, you're kidding me.
Money.
So even that alone, even that response alone should show you how this video is finna go.
Yeah, I have excess money in a savings account and looking to rebalance my portfolio to get it to work a little bit harder. Wow. But my risk tolerance is a little bit low. And he showed me how you can do this where you overfund the whole life policy. Yeah. You can access the money. You break even in year 7, and then the dividend outruns what you put into it.
Yeah,
it doesn't seem like a terrible idea in that regard, but
So let's just break. I'm gonna stop. If you guys want to watch the full video, go click on Dave Ramsey stuff. But I'm gonna break down what he's saying. So he's saying basically, a financial advisor or an insurance person came to him and said, "Hey, listen, you could pay, let's say $300 a month, $300 a month into this policy on a consistent basis for the next 7 years. By year 7, you would have broke even in your cash value to the point where all of your money would have, you would see, hey, listen, if I was paying $100,000 towards it, the compound interest would have caught up to the point where $100,000 would be in my cash value at that time, to where now I'm starting to profit off of my compound interest." So that's typically what he's saying.
I just wanted your take on why, that might not be the best way to go.
The problem is that where it gets confusing is that, God, he's selling a dividend. A financial advisor? This is an insurance guy.
Well, he's both.
So when he says, is this an insurance guy or is this a financial advisor? So typically people relate financial advisors to more like series licensed people. So if you're, you're Series 66, you're Series 6, you're Series 65, you're selling, more of securities. That's where they relate it to. They do not consider insurance people more of financial advisors, even though a lot of people still use the term. Now, a lot of people that I know that are financial advisors, they also have their insurance license. I don't know if it is required, but majority of the time, if you're working for an institution, they do require you to have your series, multiple series license, plus also an insurance license as well.
they have, it's one of the bigger companies.
Yeah, like Northwestern Mutual or Prudential.
Exactly.
Yeah. Okay. He's an insurance guy. He's not a financial advisor.
Okay, I was about to say.
So, because those are both mutual companies. Now, there are two types of life insurance companies: mutual and stock. Okay. Likely, you bought your.
So he's correct, mutual and stock. So he's basically saying, hey, the mutual side is basically where the dividends are really paid out the highest because the profits of the company goes back to the policy owners. So a lot of times when you're dealing with, specifically what he said, whole life policies or people that are dealing with infinite banking, they only usually work with mutual companies because they're able to pay back more profits towards the policy owners. Now, if it's a stock company, you typically get a lot of people talking about term insurance because all of the profits typically go back to, of course, the stockholders.
Your term unless you bought it from him, from a stock company. A stock company, stockholders own the insurance company. A mutual company, which is Pru and Northwestern, State Farm is mutual, is the policy holders are actually the stockholders. Okay?
Okay. Yep.
So when the company makes a profit, the policy holders receive a dividend as if they were a stockholder and received a dividend.
So I haven't heard a scam yet, right? So he says that, okay, the policy owners are typically the people that earn the dividend. Where's the scam? He didn't say that they didn't get anything. We're going to keep listening. It's only been about 2 minutes, but I want to know where is the scam portion. So I want to listen.
Does that make sense?
Yep.
Now, follow the math here. If you are the owner of the company and you're also the customer of the company, and the only place the company gets money is from the customers that are owners, and they give you money from a profit, by definition, that means it's because they took too much from you as a customer. There wouldn't have.
I call BS on that. I don't think that is true. I think he's trying to make it make sense, but that just doesn't make sense. Like they took too much from you. No. He says if you are owner and they're paying you dividends, that means that they took too much after they look at their profits. I don't think so about that one. I think he's trying to make sense, but it's just
Have been a profit otherwise.
Okay.
So the IRS has deemed, consequently, that mutual life insurance company dividends are not dividends in the true sense of a dividend, that instead they are, and this is the IRS's language, they are instead a refund of a deliberate overcharge. So they overcharge you in order to give you some money later to make you feel like you're making money off of them. And it's absolute hogwash. It's a pass-through. Mathematically, it's a pass-through. It's the way it has to be. It's the legal definition of the freaking company, and the IRS says so. So,
yeah. The thing I didn't love is, you.
So the problem with this conversation is like they took a portion of. Here's the main problem, right? A lot of times what people do is they try to compare the vehicles and say, okay, this one is better than this one, but they don't look at the pros and cons of each one. So when he says, hey, listen, they're trying to make it seem like you are doing such and such and such. In the beginning of the conversation, number one, he talked about his savings account, right? His savings account is sitting in the bank. Nobody goes at the bank as hard as they go at these insurance companies. These banks are not paying no high dividends. They're paying like 0.1%. You give your money to an insurance company, it's sitting there. Of course, he said he's going to break even at year 7, right? So 7 years are going to come whether you like it or not. You're going to be making money in 7 years or not. So if you're in a situation where you start profiting year 7, what's the problem here, right? It's better than having your money sitting in the bank for 7 years and you just sitting there and it's like, hey, where's my 0.0 some percent? So I think that's why I call BS on. I think, a lot of times like people don't listen to the full scenario. This guy say, hey, listen, I want something that's competitive. I just got money sitting here. The other thing is, of course, he's saying, hey, listen, I could be in a situation where I want to gain dividends and earn interest off my money without it being locked up. And that's the other thing that a lot of people don't talk about is these other vehicles is locking your money up. He spoke about the IRS. The only reason why the IRS has to word it that way is because they don't pay taxes on those dividends. They don't pay taxes on the growth of that. So they're missing a lot of context when it comes down to the reason why they could put money in these vehicles versus putting it into a mutual fund or versus putting it into another type of security. So let's keep going. Let's see what he's.
When you take the money back, you basically are paying an interest rate on it. But
Exactly. And whose money is this?
Right.
That you're borrowing your own money and you're paying them interest?
Yep.
This is infinite banking for them.
So I'm explaining the interest portion. A portion of that is true. A lot of times, of course, if you do the infinite banking concept the right way, you can get your interest wiped out. Like you don't have to be in a situation where you are earning interest. And the way he's saying it, he's not giving you the full concept. What they're not telling you is that when you borrow your money is still growing as if it's still there. That's the portion that they're not saying. So they're saying, hey, you borrow your money and now you got to pay it back. It's not like borrowing from a 401k. It's not like borrowing all these other vehicles. You're still earning interest as if it is still there. And there are certain cases to where I'm gonna go over to where typically if you use the infinite banking concept the right way, you'll be in a situation where you could cancel out that interest. So you could pay, like there's certain companies that say, hey, listen, if you pay this loan back within the first 12 months, guess what? You will get credited back the interest that we took from you, or we're not going to take any interest from you at all. So, and we're still going to credit you this same amount of interest that you would earn as if it was still there. So it's certain portions of the conversation that he's trying to gaslight that he's not. I think that's the right thing to say, gaslight. I don't know. He's probably not gaslighting, but I just think he's dragging it just a little.
Yeah.
Yeah, the infinite banking concept is old school, whole life, done poorly. You need a real financial advisor, not an insurance broker that's trying to sell you a load of manure.
So let's also talk about this, right? He says he needs a real the reason why I like the insurance space is because you're in a situation where you're dealing with contracts, right? When you give your money to these quote unquote financial advisors, professionals, whatever, and these stockbrokers, they can't give you a contract. They can't tell you, hey, this is exactly how much you're going to earn. When you're dealing with insurance, you know exactly what you are dealing with, and you're in a situation where there is a zero downturn potential, no risk. So when he says you need to get to a real person, guess what? We're talking about real risk. We're also talking about real taxes that you have to pay. We're also talking about, hey, listen, we're talking about a potential over here. This guy is talking about his savings account. He's talking about everything that he has. So he's not in a situation where he's trying to grow and get money overnight. He's just trying to gain a little bit more interest than just is sitting in the bank, and he doesn't want it locked up. And he also don't want to be in a situation to where he'd be penalized just based on his age. So a lot of people don't go into details in regards to why these are so popular for the consumer. If it was such a scam, everybody wouldn't be doing it. And he said it's old, O-L-D. That means that it's been around for a long time. So these are not concepts that these people just came up with, when YouTube came out. These are concepts that he's been hearing his whole career. His whole entire career. So that's why he said, oh Lord, because he's heard of it before. But due to the fact that you just, you don't understand it in a sense, doesn't mean anything. Now, do I think everybody need to put their money into this? Absolutely not. I don't think it works for everybody, but let's finish the video and then I'm gonna go into more details on how that works.
And so, yeah, the other thing is that your cash values that are sitting there all die with you. So whatever cash you put into this is equals zero at your death because they only pay the face value. Pru does not have a policy. Northwestern Mutual does not have a policy that pays more than the face value except Universal Life Bs, which are not an infinite banking product.
And that's not true as well. So there are some cases, majority cases should be where, let's say I start off the policy at $50,000, right? And then I put in another 100,000. My death benefit grows with the initial face amount, the initial face value. So if you're in a situation where if something was to happen to you and now you got to pass on and they put in a claim for that death benefit, you will get whatever the cash value was because now the death benefit has changed. It grew over time. So if I put in 50,000 and my death benefit started off at 50,000, now my death benefit is 100,000. If I put in 100,000, my death benefit started off at 50,000. Guess what? Now my death benefit is 150,000. So that's BS. Now when he talks about, oh, you only get the face value, that's just not true. There are certain cases to where you have people that their situation may be, hey, listen, your cost of insurance is going to be a little bit too high to where they'll tweak it a little bit, but that's just not true. In some cases, of course, you know, a lot of people really depend on the illustration, but they're not going based on the fact that it's so many factors that matter if that person is in a situation or not. What he's not also saying is that you're getting more than whatever you put in. That's the thing about insurance. It's a freaking contract. If you started off, right, where are you gonna go right now with your $250 a month and have a $100,000 death benefit, $100,000 net worth to where it passed down to your family if anything was to happen to you? There are no places to where you can go. So you also have to add in that you're taking your pennies to buy dollars. You also have to add in that you're buying money in a sense. So you're putting your money in a vehicle that's, number one, is buying money, is growing interest as if it's tax-free, and it's also in a situation where when it does grow interest, when it does build the cash value, you can actually take from it. Now, again, a policy can be designed in so many different ways. If you're dealing with a whole life policy, you definitely should have a policy build cash value day one and be able to borrow from the policy within at least 10 to 15 days. 10 to 15 days of having a policy. Now, some cases you can't do that. They require like 12 months, but it should at least be borrowing. It should at least be building cash value day one, at least.
Products. And Universal Product B is where they charge more than they usually charge, which basically buys the insurance so they can still keep your money, is the way the math actually works on this. So you're dealing with one.
And now he's just talking about Universal, which that's just not true at all. Like, he's not going into real specifics, right? Universal A, he's saying death benefit A is where, of course, it stays level. The death benefit stays the same. The cost of insurance typically it doesn't do much. Majority of those universals, the cost of insurance cuts off in about 10 years. So that's the other thing he's not saying. Like, a lot of stuff that people are talking about when it comes down to the finance space, this is not crypto. This is not the e-commerce store that's going to blow up over time. This is not supposed to be an income-driven vehicle. This is supposed to be a vehicle to where you're just storing your money. So we're not in a space to where we're looking at doing some crazy returns on Apple and all of that. Like, we're not doing, even Apple doesn't even do that. They grow every once in a while. But, you know, I'm going to show you guys a chart on where they're telling you to put your money. And I want you to, you know, explain to me how does that even make sense for it to be a better vehicle, for you to put your money in a vehicle that's going to have a huge drawdown potential versus putting your money in a vehicle that's going to give you some type of guarantees. And they all are going to equal up to the same amount by the time you get to that 20, 30-year mark.
One of the most expensive insurance products in the marketplace, if you're dealing with either one of those two companies, I would stay completely away from both of them. They're everyone in the financial field except people that work for them, we all think they're a joke.
And the other thing is, too, that's BS. You know, nobody thinks anybody is a joke. If everybody, the only people that don't think it's a joke is because they try to make this thing a competitive thing. And it's not a competitive thing. What it is it's an idea of a concept. You should not be doing a either or thing. This is not either or. You should be doing both and. You should have your IRAs. You should have your 401ks, your 403bs. You should have your mutual funds. And you want to understand what are the pros and cons of each one, right? And it's based on your age, it's based on your health, it's based on what you're looking to do at that particular moment. It's based on how long are you looking for this process to be. And I'm going to explain in a sense, I really don't even want to watch this no more because I'm getting a little bit too passionate, and I'm really not passionate about any of this stuff. I'm just going to be honest. I just understand it at a different level. But I would just say this, what he is saying is not correct. It's not, because a lot of people do not go into details in regards to everything. They leave out so many different concepts on how everything works. So I'm gonna go, you know, of course, to let's just click on some other stuff. I just had like, you know, he talks about, of course, if you was to get a certain amount. So let's just say, for example, I'm on a compound interest calculator, right? I'm on a compound interest calculator, and the initial investment, let's just say you start off at a basic of $500 a month, right? Well, why would you want to pay $500 a month? You don't have to do that with term. We're not talking about term insurance. Y'all got to understand that insurance is a concept scenario, okay? So when you talk to people, especially on YouTube, this is a very broad concept. So when they're having these conversations, it may or may not work for you. $500 a month may not be nothing for you, right? It may be a lot for you, right? So what you want to do is you want to look at, okay, what am I saving on a consistent basis, and take a percentage of what you're saving on a consistent basis. For the average American, $6,000 a year is not a lot to put away for, of course, your future. So let's just say they're doing, you start off at the $500 a month, and your monthly contribution is $500 a month. This is the power of, I know you guys have probably seen a penny doubled in 30 days. This is the power of a penny doubled in 30 days. The power of compound interest. This is exactly why a lot of people, when they get older, they're extremely well off, because they look at day one, boom, it's 1 penny. Look at day two, boom, it's 2 pennies. They look at day three, boom, it's 4 pennies. By the time you get to day 10 and you see it's only $5, you get a little bit pissed off, because you're not at a point to where you want to be, because you're so distracted by social media. You're so distracted by, what people are saying. Oh, this ain't doing that. This ain't doing this. But in reality, guess what? Where's the risk here? You didn't go down not once. Look at this. You didn't go down not once. So these are the conversations that you want to have when it comes down to where you're putting your money. You don't start to do anything. You don't even pass $1,000 until day 18. Day 18, that's when you pass $1,000. But the real juices start to flow once you start to get to 6 figures. You don't even get to 6 figures until 25 days down. But in 5 days, you go from 6 figures to a multimillionaire because of the power of compound interest. So this is what you want to look at when you are, when you're looking at certain concepts and you're comparing concepts. So let's say you got $500, right? $500, 20 years is going to come either way, you want it or not, right? And let's just say it's at 4%, right? Let's just do it easy 4% compound interest on an annual basis, right? In 20 years, you'll have $179,000. Now, why is that so important? Why is this so important to build money off of compound interest? Is because if you show this table, let's just say every year you're earning money off the money that you put in the beginning. So when they say, hey, is your money still working for you? Right? I used to ask people all the time, all of the money is flowing through your bank account over the last 10 or 15, 20 years. How much of that money is still earning you money still to this day? So guess what? In 20 years from now, the money that you had 20 years ago, is it still earning you interest over time? Okay, so $179,000 may not be a lot of money, but guess what? You only put in $120,000, right? So now you're thinking about it. Oh wow, man, okay, that's that. My $120,000, it could have been a little bit more, but guess what? The difference between infinite banking and then a traditional, let's say a traditional mutual fund or anything like that, the difference is let's say you just start doing that $500 a month, right? And you at that 4%, and it's at $179,000. When they say you can borrow your money, you can take out this same $179,000. We suggest you go fund an income producing activity and still be in a situation to where you would still grow interest on this full $179,000. So let's just say, right, year 10, right? You take out $72,000, you go invest into a property, go flip a property, do what you got to do, right? That next year, you still have $81,000 compound interest, even though you took out that $72,000. That's the power of infinite banking, right? Guess what? That money that you're earning inside of that vehicle is not locked up. That money that you're earning is being what we call leveraged. It's being leveraged over time. So these are the type of things that, that he's not talking about. He's not talking about. And when he talks about the UL, the Index Universal Life Policy, when you're looking at a performance, guess what? This is North American. I don't write with North American. I've never even done business with them. So I'm just going to look at it. Was just the only company I was able to see what they historically have done. So when you're looking at an Index Universal Life Policy, they talk about the S&P 500. The S&P 500 is a great performing vehicle, but guess what? They don't talk about the lows. They don't talk about the fact that the S&P 500 is it goes down. Like, does it catch back up over time? Absolutely. But, no one thinks an insurance person is a joke. You want to know why? Because the clients are not banging at their door. They're not jumping off a cliff because their retirement is, look at this, 2008, right? Let's just say you just use some of these financial gurus' advice and putting all your money into the S&P 500. It went down 38%. Now I want you to think like the person that's about to retire in 5 years, right? Usually they say a baby boomer, I don't know, I think how much does a baby boomer need to have? Much does a baby boomer need to retire? Right? These are the questions you want to have. How much does a baby boomer need to retire? The median retiring baby boomers need around about 200,000. I don't believe in that. Retirement savings is estimated to retire. I don't think that's true. I think it's like $1 million. I think it's like $1 million. Yeah, like 200,000. What the hell are they gonna do with 200,000? Come on now, not in this economy. Not in this economy at all. You know what 200,000 is? Like, come on now. 4% rule. Yeah, that's BS. It's not 200,000. Let's just say it's $1 million, right? That $1 million, right? And you just drop down 30%. Guess what? You got that $1 million and it just dropped down 30%. Guess what? Boom. Now it goes from $1 million, right, down to what's $1 million? Let's do the math here. 1 million. Minus 38%. Okay, let's see where we at. 1 million is $662,000, right? Now we at $662,000, but guess what? We're not done yet. It's time for you to retire, but let's see what the IRS says. What will the IRS tax bracket be on 600? And these are the types of conversations that you want to think about, right? What's the IRS tax bracket on 632,000, right? 10% on the first 11, 22% on the final. What the heck is this? Okay, let's go here. Let's see what this says, right? If you're over $600,000, guess what? That's a 37%. So now, right? Now times minus, let's say minus 37%. I don't think I did that right, but you get the point. I mean, we're losing so much value over time because we're not implementing all of the other people that got their hands in our pockets. So when you're talking about this infinite banking concept, these are the types of, this is what you're looking for. A lot of people that look at those vehicles, they're looking for something safe. They're looking for something consistent. And if we look, over time, I mean, this stuff is scary, man. You're losing 28%, and then the next year you're at 23%. Okay, cool. It took you 2 years to just get back at where you was in 2007, right? And then the next year it only does 1%. So a lot of people, they don't have a good heart to do that. So that's another thing that people don't talk about the concept. But the main thing, when I got started in the industry, where we started talking about the concept was dealing with, of course, funding an income producing activity. So I want to break this down for you all really quickly. I don't know how long this video is going to be, but I'm pretty sure it's going to be a good video. And I hope you all like this. Please drop something below if you like it. Yeah. All right. So let's just say, for example, right, you want to start thinking like a bank, right? And when they call it infinite banking, it's because you want to start thinking like a bank. And a bank is in a situation where they understand the rules to the game. Think about this, right? When you first started playing tic-tac-toe, who was the person that showed you? And I'm guaranteeing that's the person that won. This is the type of games that the American dream holds in their hand. This is the type of games that they play with the American people. They tell you, okay, you need to save, right? Average American is only saving 3.8%. They say that you got to pay taxes. Average American is paying 24% of taxes. Guess what? They say that you need this lifestyle. Once you get this lifestyle, now guess what? Now you got to pay interest on the debt that you just accumulated, which is 50%. And the average debt is about 137%. So that's one thing that me and Dave Ramsey really, really do agree with is, I don't believe that debt is the superpower, but I do believe that good debt is a really, really good superpower for a lot of people. A bank is a business, and you got to start thinking like a bank. How do banks give every dollar a job. When they say you got to make your money work for you, you have to figure out, how can I put my money in places to where it's going to work for me without me even being there. Don't get into this mindset of, shout out to crypto. Yes, I believe everybody should have some money into crypto, but crypto should not be your only source. You want to also have some type of realistic model as well, to where, of course, the little interest rates don't count them out. The little interest rates matter as well because they're a little bit more guaranteed. So let's say you give the bank $10,000. You give the bank $10,000, they may give you 1% on a lucky day, right? But guess what? If you go try to borrow $10,000, same $10,000 that you gave them from the banks, they're going to charge you 24%, 18%, 9%. Why? Because they figured out how to give their dollar a job. They figured out how to make this thing work for them, how to make it make sense for them. And that's why they're able to be that successful. So when you're dealing with, of course, this strategy, you have to understand that this strategy is in a sense of we're trying to figure out how to give our dollar a job, but multiple jobs. So we're not just trying to make interest. We're trying to make interest, but also create passive income. This is what we suggest. Figure out how to create some type of passive income. So let me go out of here. I'm not going to do this one today, but let's say, for example, right? This is your tank. This is where your money is. This is where your money is, right? Everything that you're paying for typically is going to be cash. And there's problems with paying with cash because, as I just showed you, there's a tax leakage. Once you save all your money up, now you're in a space to where, of course, now you got this tax leakage. Every single time it's time for you to save for a rainy day comes, and now guess what? That rainy day leaks some stuff out. It leaks it out. Now you got to continuously keep draining the tank. What I showed you on that other screen was you didn't have to keep draining the tank. All you had to do was be in a situation to where you continue to keep funding that particular vehicle and you were still earning interest without draining the tank. So when you're talking about the infinite banking concept, it's a little bit more safe because you're not losing any interest over time. There's no loss provisions, so you're not losing anything over time. You're getting guaranteed interest, plus you're also getting a guaranteed saying that, hey, I'm not losing any money. You also have tax deferred growth, meaning I'm not paying taxes on the growth of it, so I can hide my money into a vehicle to where I don't have to pay taxes. I don't have to report it to the IRS, right? High contributions. Everybody want to talk. Let's stop for a second, right? Well, you know what? I'll get to that on the next one. Let's talk about, of course, liquidity for you to be able to have use and control to take that money right back out. You can't do that in certain vehicles, and that's the problem that a lot of people are not talking about. Remember I told you I was going to show you with the S&P 500, right? Let's look at the S&P 500. These are real numbers, right? You start off with 100,000 in the S&P 500. By the time you get to 2,000, okay, it would have did a 36% return. You would have been at 136,000, okay? But what happened in 2001? They had 9/11. Guess what? Your portfolio went from 136,000 all the way to 76,000. Now, listen, disclaimer, I understand. Financial planners, there's different softwares, safe provisions. I understand. Technology is at a whole different level now. I'm just using this as an example, so calm down. So now you at 78,000. But guess what? There's a lot of people that just they go to these articles and they just put their money in the S&P 500 because that's what it says. They just buy these stocks. And guess what? They don't have any loss provision. So now your 136,000 is now down to 78,000. Okay? So now it takes years for you to get back to that same point that you were at in 2000. It took you 7-8 years to get right back to that point. And guess what? Happens again? Another cycle. It's called a wealth cycle. It's called a cycle that puts you in a situation where the market has to do a retracement. And it did that retracement again, and it dropped right back down to 100,000. So now you back at where you started in 2009, and it's been 9 years, all because you put yourself in a position to where you don't want to do an infinite banking concept. You want to just put this money in this thing yourself. You didn't want no guarantees, right? Versus the other person that started off with 100,000. Let's look at the green. The other person that started off at 100,000, they just want to get some, quick, good interest over time, so guaranteed interest over time with no loss provisions. This is usually the index universal that grew over time. It only grows when the market grows. And now you're in a situation where by the time 2010 comes, guess what? You're at 160,000. Okay? 2009, you at 160,000. Okay? So guess what? Who would you rather be? This is the type of conversations that you want to have with yourself. Who would you rather be? You rather be the person that's just stuck where they was and they want to blame it on the market, or do you want to be a person that's in a more safe guarantee, right? Okay, boom. Now let's keep going. The S&P 500 shot up over years. Boom, 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 boom. Guess what? Now it's time for you to retire. It's time for you to start thinking about retirement once you get to about 2015 or 2013, because it's 5 years out. Really, you should have been thinking about it the whole time, but let's just say 5-10 years out, right? Now you get up to the point to where you're in this good safe haven. But the problem is you don't want to go through this roller coaster. This is a roller coaster ride, right? And I'm not saying don't have money in this vehicle. I have money in these vehicles. So you want to have your money in these vehicles. But again, I just want to show you the difference here. I want to show you why people are choosing this infinite banking model. I'm not selling you. I'm just literally showing you if it makes sense or not. And then you also want to look at, the tax burdens, right? Once you pull this money out in this portfolio, 217, depending on the year, they're going to tax you good 20-30% unless you got a good CPA that understands the tax codes. Guess what? Most people don't. They're just working a regular job. They don't have any benefits because there are no benefits for W-2 employees like there are for 1099 or people that are business owners or they have a side hustle. There are no benefits. So guess what? You already know in the future your taxes are going to be higher. So you got your money in these 401ks and you already know, hey, listen, I don't have to pay. And they're matching me and all this other stuff. Guess what? When they do match you, you're going to pay taxes on that match too. So this is what you want to look at. So look, I really like this slide, right? Because it talks about the government plan for your money. We're talking about your money, right? They say, hey, listen, you're gonna give me all the money, right? And this is typically for people who put their money into like 401k portfolios or whatever. You're going to give me all the money, right? You're going to take all the risks. You manage the business the day-to-day, meaning you got to go to work. You got to keep going to work, and you got to keep putting this in there. And then you can't touch this money until you're 59 and a half. And then when you are 59 and a half, then I'm going to tell you how much you owe me, even though you took the risk. And it don't even matter if the portfolio is lower. It doesn't even matter what year it is. It don't even matter if we still break even. If I put in 100,000 and then 10 years later it's time for me to retire and I'm still at 100,000, guess what? I still got to pay taxes. So this is what you want to look at, okay? So I just wanted to break down, of course, this infinite banking concept because it is a huge conversation that a lot of people are having. You can get, certain books. I have different books that I can be able to, I'm going to drop it below that you can take advantage of. But like, comment, subscribe. I really, 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 really hope you all like this video. And I pray that I am consistent enough and we blow up enough to get a little bit more. I really like talking about these concepts. It's a little nerdy stuff, and I pray I find some nerd friends that can really talk about this with me. And if you're a financial planner, financial advisor, listen, don't hate me, please, because I know you guys are taught like for the American people, right? I don't know why you guys are just term. I get it, right? Because it's your business model. But at the end of the day, don't say F whole life. Like the people that are usually saying F whole life or F index universal, that's usually all they can sell. So you guys have to understand, especially as consumers, you got to understand it's a business and everything. So when you're hearing people talk about this stuff, guess what? They're talking from a business standpoint. They're talking from a standpoint of, hey, listen, this is what we're pushing because this is the product. This is the product we're pushing, right? I wouldn't say that, but if a person is selling this type of drug, listen, they're going to tell the crack addict that this is the crack. You don't want to go smoke weed. You need to be doing crack because I sell crack. That's typically all these people are doing. I mean, it's all the same. We ain't making no real money doing it, but I just want you guys to understand that it's a lot better putting your money in a pool of money than just having your money just sitting there, right? And you want to use these systems. I learned early on, can't beat them, join them. And then when you do join them, figure out how to play the game with them for you to win, okay? So let's get it. I believe that you're going to win. I believe that, some great things are going to happen. Please check out my other videos on here because I truly believe that you deserve it. Let's get it.